Welcome back to the channel. Today, we're going to be looking at how the stock market reacts when the Fed cuts interest rates.
Yeah,
It's a pretty hot topic right now.
definitely.
Lots of different opinions out there,
hmm
but we're going to cut through all that noise and just look at the historical facts and what they might be able to tell us about what's happening today.
Sounds good.
Now, a lot of people just assume that when the Fed cuts rates, the market automatically goes up.
Right.
But it's not really that simple, is it?
Not at all. It really depends on what's happening with the economy more broadly.
Okay, so sometimes, the Fed will cut rates just as like a preventative measure
hmm
when the economy is doing okay, but maybe just needs a little boost,
Yeah,
kind of like a tune-up.
I like that analogy.
And usually in those cases, the market reacts pretty well.
Yeah, we've seen that happen a few times in the past, like back in 1984, 89, 95, even more recently in 2019.
Oh, yeah.
The Fed made some small adjustments to the rates and the market continued to perform well.
But then there are those times when the Fed cuts rates because they're really trying to prevent or at least soften the blow of a recession.
Right.
And in those situations, the market can react a lot more negatively.
Yeah, because investors start getting really worried about the bigger economic picture.
Makes sense.
If we look back, we see this pattern in 2001 and 2007. The Fed cut rates, but the market still took a pretty significant hit.
Like, how much are we talking?
The S&P 500 lost over 10% both times.
Wow.
Yeah, so that's why it can be misleading to just focus on like the average market return after a rate cut.
Yeah.
Sometimes you hear people talking about that 11% average,
Yeah.
but that lumps together all the good times and the bad times.
Right.
You got to understand the context and what the Fed is trying to do with those cuts.
Okay, so now fast forward to today.
Okay.
The Fed has already cut rates 3 times this year.
That's right.
Half point in September, a quarter point in November, and they're probably going to do another one in December.
Most likely.
So historically, the market tends to gain about 9% on average
Yeah, about that.
in the 6 months after that initial rate cut.
Uh-huh.
But this is where things get kind of interesting
How so?
because there's been a lot of debate about whether or not the U.S. has actually already been in a recession this year.
Yeah, that's a whole other conversation.
And that debate really comes down to how we define a recession.
Right.
A lot of people think that if you have 2 consecutive quarters of negative GDP growth,
Yeah.
that automatically means you're in a recession.
Mm-hmm.
And we actually did see that happen earlier this year.
We did, but the official definition that's used by the NBER,
MBER.
yeah, the National Bureau of Economic Research,
Okay.
it's more complex than that.
So what do they look at?
They consider a bunch of different factors like employment, industrial production income. It's not just about GDP.
So they're looking for a decline across multiple indicators.
Exactly. And it has to last for more than just a few months.
Okay, so because there are these 2 different interpretations,
Yeah.
there were a lot of people accusing the Biden administration of trying to, change the definition of a recession
Right.
so that they wouldn't have to admit that we were in one.
Exactly.
But the White House kept saying they were just emphasizing the NBER's criteria,
Mm-hmm.
not trying to come up with new ones.
Right. And actually a bunch of fact-checking organizations like Newsweek, Snopes, PolitiFact, they all agreed with the White House.
Oh, interesting.
Yeah, they all said that the White House's position was in line with the NBER.
So it seems like there wasn't actually a change in the definition.
Right. Just different ways of interpreting it.
But obviously all this just adds to the uncertainty around these current rate cuts.
For sure.
Because if we have been in a recession historically, that means the market might go down even more.
Yeah, even with the Fed stepping in.
And how much of a drop are we talking?
On average, about 11% 3 months after the first rate cut during those times.
Wow.
But here's the thing.
What's that?
We haven't seen that drop yet.
Oh, really?
Nope. The market's actually been hitting new highs since those cuts started back in September.
So what does that tell us?
Well, it could mean that we're not actually in a recession
Okay.
and that maybe the economy is stronger than some people think,
Okay.
or it could be that this time is different
Okay.
and the market is just reacting to these cuts in a new way.
So it's a real puzzle.
It is.
And figuring out what it all means is really important for investors right now.
Absolutely. It really does make you think.
Yeah, do we need to rethink how we understand the market?
Maybe. Especially with all the weird stuff we've been seeing lately.
Yeah, it's like the old rules don't apply anymore.
Right. Like,
Oh.
who would have predicted that the market would keep going up? Even with all the recession fears and the rate cuts,
It's wild.
it just shows you how much human behavior and psychology are driving things.
And that makes it really hard to predict what's going to happen.
Exactly.
Speaking of human behavior, I wonder if all the debate about the definition of a recession Maybe that had something to do with how people reacted to these rate cuts.
Oh, that's interesting.
Like if people weren't sure whether we were already in a recession or not, maybe they weren't as quick to freak out when the Fed started lowering rates.
Yeah, that makes sense.
Like maybe they thought, oh, well, maybe things aren't as bad as we thought.
Right, maybe it gave them a little more confidence.
So it's possible that all that debate actually kind of pushed back against those historical trends.
Yeah, it's definitely possible.
It's just another example of how everything is connected.
Exactly. The data, the sentiment, the psychology, it all plays a role.
Okay, so let's say for a minute that we're not in a recession and that the market's positive reaction to the rate cuts is like a genuine response.
Okay.
What could that mean for the economy going forward?
Well, it could be a sign that the U.S. economy is a lot more resilient than we thought.
Like it can handle higher interest rates and still come out on top.
Right. And it could mean that the Fed's cuts are doing what they're supposed to do.
Stimulate growth.
Yeah, make it cheaper for businesses to borrow money and invest.
And then hopefully they'll hire more people and consumers will spend more.
Exactly. It creates this positive feedback loop.
And that could lead to even more growth.
Right. So maybe we'll see a nice long period of market growth,
Right.
driven by both the rate cuts and a strong economy.
It's definitely possible. But we can't forget about the risks.
Of course not.
Like what if the Fed cuts rates too much?
Yeah. Then we could end up with inflation.
And then they'd have to raise rates again.
And that could lead to a market correction.
Ugh. It's a tough balancing act.
It really is.
And then there's always the chance of something totally unexpected happening, like a geopolitical crisis or a natural disaster.
Right, those things are impossible to predict.
But they could have a huge impact on the economy and the market.
Absolutely.
So even though things seem pretty good right now, we got to remember that there's always some risk involved with investing.
Always.
Okay, so now let's flip it around. What if we are actually in a recession, even though the market isn't acting like it?
Interesting.
It could be that the market is just slow to react,
Yeah, maybe it's kind of in denial.
like it hasn't fully processed what's going on yet.
Right, or maybe the recession is still in its early stages, so the full impact hasn't hit yet.
So we could see a delayed reaction, like the market could drop suddenly once it catches up to reality.
Exactly, and if that happens, we could be in for a pretty rough correction.
Especially if investors start panicking and selling everything.
Yeah, fear is a powerful motivator.
So even when things look good, it's important to be prepared for a downturn.
Definitely.
So what can investors do to protect themselves in this kind of uncertain environment?
Well, one thing they can do is focus on companies that have a good track record, companies that are profitable and have strong financials.
So basically, companies that are likely to survive a downturn.
Exactly.
What else?
Diversification is key.
So don't put all your eggs in one basket.
Right. Spread your investments across different asset classes.
So if one area does poorly, the others can make up for it.
Exactly.
And probably the most important thing is to think long term. The market tends to go up over time.
Right. Even if there are some bumps along the way.
So if you can avoid making emotional decisions and just focus on your long-term goals,
You'll be in a much better position to succeed.
so stay informed, stay disciplined, and don't panic.
Great advice. It really makes you think about the bigger picture.
Yeah, like even if the market is doing well, that doesn't mean everyone's benefiting equally.
Exactly. Economic growth and market gains can actually worsen inequality sometimes.
Right. It's not always a win-win situation for everyone.
And it's important to keep that in mind when we talk about these trends.
Absolutely. Okay, so before we wrap up, I want to talk about the Fed for a minute.
Okay, the central bank.
They've got a tough job, don't they?
They do. Trying to manage the economy is no easy feat.
They have to keep inflation under control,
Right.
but also make sure the economy keeps growing.
And sometimes those two goals can conflict.
Yeah, that's a balancing act.
And of course, all their decisions about interest rates have a huge impact.
On borrowing costs, mortgage rates, the value of the dollar.
So everyone's watching their every move.
Makes sense.
And it's not just people in the U.S. who are paying attention.
Right, because our economy is so tied to the global financial system.
Exactly. So the Fed's actions can ripple out and affect other countries too.
It's a lot of responsibility.
It is.
So as we wrap up this look at the rate cuts and market reactions, I think the biggest takeaway is that there's no crystal ball.
Nope.
We can't predict the future with 100% certainty.
The economy is just too complex for that.
Yeah, there's so many different factors at play.
But we can look at historical patterns and analyze what's happening right now.
And hopefully make some educated guesses about what might happen next.
Exactly.
But we always have to be prepared for the unexpected.
Always.
So stay informed, stay curious, and stay adaptable.
Great advice.
Well, I think that's about all the time we have for today.
It's been a great conversation.
I agree. Thanks for joining me.
My pleasure.
And thanks to all of you for listening. We hope you found this discussion helpful. If you did, please don't forget to like and subscribe to our channel for more deep dives into the world of finance and economics. Until next time, keep learning, keep questioning, and keep investing in your knowledge.
And in yourself.
See you soon.